Hello everyone. Assalamu alaikum warahmatullahi wabarakatuh. My name is Nadia, with student ID 23412026, from Class AKT 23A. Today, I'm going to present a brief explanation about cost concepts and financial statements, a topic from our cost accounting course. Let's begin. First, let's define what cost means in accounting. In simple terms, a cost is the value of money that has been used to produce something or deliver a service. It's an economic sacrifice measured in monetary terms, often used to acquire goods or services. There are different types of costs in accounting, such as fixed costs which remain the same regardless of production volume, like rent or salaries. Variable costs which change depending on the level of production, like raw materials or utilities. Direct costs, costs that can be traced directly to a product, such as direct labor or raw materials. Indirect costs, costs that cannot be easily traced to a single product, like electricity used in the factory. Understanding cost classification helps businesses make better decisions, especially regarding pricing, budgeting, and cost control. Cost plays a critical role in managerial decision-making. For example, if a company wants to launch a new product, they must analyze the total cost of production to determine the break-even point and expected profit. This helps managers decide whether or not the product is financially viable. Cost information is also used to set selling prices, reduce unnecessary expenses, and improve efficiency in operations. So in short, understanding cost is essential not just for recording transactions, but also for strategic business planning. Now let's move on to financial statements. Financial statements are formal records that show the financial activities and position of a business. There are three main types. 1. Income statement, also known as the profit and loss statement. It shows the company's revenues, expenses, and net profit or loss over a specific period. 2. Balance sheet shows the company's assets, liabilities, and equity at a specific point in time. 3. Cash flow statement reports the cash inflows and outflows from operating, investing, and financing activities. These statements provide valuable information to various users such as management, investors, creditors, and even the government. So, how are costs connected to financial reports? Costs directly affect the income statement. For instance, cost of goods sold or COGS is subtracted from revenue to calculate gross profit. Managing costs effectively can improve profitability, which is then reflected in the financial statements. In the balance sheet, inventory valuation involves cost accounting as well. The value of inventory affects both assets and net income, depending on how it's reported. In summary, without accurate cost data, financial reports can be misleading. Costs are an essential part of every business transaction. Understanding different types of costs helps in controlling expenses and making smart business decisions. Financial statements give us a clear picture of a company's performance and position. Together, cost concepts and financial reports are powerful tools for decision-making and strategic planning. Thank you for your attention. Wassalamu alaikum warahmatullahi wabarakatuh.